Hello there, Whitney and Manuel here. Welcome back to our series on retirement plans for business owners. Today, we're going to be talking about 401k. So one thing that a lot of people don't know about is actually called a solo 401k. This is the same type of business that would set up a SEP IRA. So you're a smaller company, just solo, it's just you. You may have contractors, but you're the only employee. That's the name solo 401k. So the question is, why would you contribute to a solo 401k? So let's go back. Remember with the SEP IRA, it ends up being after your payroll tax is deducted and your eligible income is determined, you can only contribute about 20% to a SEP IRA. However, with a solo 401k, you can contribute as an employee and you're limited once again, but you as an employer can match it. And so that's one really big benefit of a solo 401k. So let me give you an example. Someone earns $75,000 from their S Corp. Let's they're a solo owned S Corp and their payroll is $75,000 because keep in mind, it's based off of payroll income. So let's look at $75,000. 20% of that is only $15,000 that you would be able to contribute in that scenario. However, let's say you so that would be your SEP IRA max, but let's say you are able to contribute more and you want to contribute more because you've got more profits. It's just that you've kept your payroll at $75,000. You as the employer can match $15,000. So then total contribution into the plan is $30,000. The max of a solo 401k and SEP IRA are both the $66,000 that you can contribute as a combined employee and employer contributions. So we like that. One other big benefit of a solo 401k is that depending upon who you set the plan up with, you could do Roth employee contributions, meaning that those will be tax-free. If you do all pre-tax, then those will be income taxable when you make withdrawals in retirement. So what we do is we set up a lot of Roth employee plans, and then the employer matches pre-tax because you can't do matches with Roth dollars. Then we transition to a group 401k. So this is where you've got a group that you are setting up a 401k for. And so as this is where it gets a bit more complicated. Now there is administration of a solo 401k. You have to do the record keeping and you normally hire someone for that and you have a third-party administrator. So there are expenses associated with the solo 401k or group 401k. There are more expenses with a 401k than there are a SEP IRA and a simple IRA. So that's what keeps people from doing that. However, with the group 401k, you enter in a whole other type of testing. And so this is testing for discrimination. It's subject to ERISA, which is what oversees group employment plans. And so when it's subject to this, it requires another level of testing, making sure there's not discrimination, make sure it's not a top-heavy plan, meaning that just the highly compensated employees are taking advantage of it. And so with this, sometimes what happens is that the highly compensated executives or the CEO cannot contribute as much because his or her low compensated employees are not participating. So you can run into some issues here. So a way to get around that is by doing a safe harbor plan. And by doing a safe harbor plan, then you know that you can still max out the 401k as an owner or as a highly compensated. So a safe harbor match minimum is 3%, which is kind of like what I was talking about with that simple IRA, a required 2%. With the safe harbor, it's a required 3% right from the beginning. It's a non-elective contribution that you just usually have your employees just automatically elect into that 3%, and then you match it 3%. And so a lot of people will do this. A lot of owners will do this so that they can then maximize theirs. You, of course, have to make sure this is all in your budget, right? So I started from the least expensive going towards the more costly plans. But a group 401k does make good sense if you have the cash flow for it and you want to retain employees and you want to be able to contribute more. You can add profit sharing to 401k plans. You could do match to the 401k plans. Profit sharing is a percentage of compensation based on the performance of the company, not required to do that every year. And you could also have a profit sharing outside of the 401k as well. But again, that's contributing to all eligible employees, regardless of if they're participating in the plan. So that's why some people shy away from that. But I'm personally a fan of profit sharing, and I do recommend that pretty frequently. So a decent amount of information in 401ks. I could do a whole class on 401ks, but I just wanted to give you the basics. Next time I'll be talking about cash balance plan, which is another ERISA type plan, but much different than a 401k.